Hello everyone, welcome to the latest Brooks Macdonald discussion on retirement strategies. I'm delighted to be joined today by Heather Hopkins, founder and MD of NextWealth, a market research firm.
Great to be here, James, thank you.
We have an exciting and timely discussion today, Heather. I look forward to hearing your views and to share Brooks's perspectives. I wonder if we could kick off with what's driven all this, which is ultimately the regulatory environment designed to protect the outcomes for the end retail investor. When it comes to the concept of retirement planning and advice, the FCA has been hot on this going back to 2019 now, certainly culminating in the thematic review of last year. Keen to get your views, having discussed this with no doubt multiple wealth managers, discretionary fund managers and then clients, as to where you think the direction of travel is heading from here.
Yeah, absolutely. It's been a huge amount of change to the approaches to delivering advice to clients in retirement. And it started with the pension freedoms, and that's over a decade ago. And since then, advisors tell us that this is a planning challenge, that they need to support clients through a long journey into accumulation that can last 25, 35 years for some clients. And if we start with the framework that they're using to deliver that advice, CRP is bandied around. We talk about a framework for delivering advice that sits alongside the centralized investment proposition. And in our last survey of advisors, half said that they have a CRP in place now, and 20% plan to introduce one within the next year. And so that's a huge amount of change happening within the market, with a fifth of advice firms looking to introduce a new framework that's consistent across the firm for delivering that advice. And that can be the approach to assessing risk, cash flow modeling, all of those different conversations that help that planning conversation that lead to the investment solution that's recommended at the end of the day. And I know you've been out speaking to advisors. Are you hearing similar things?
Absolutely. What I think is fascinating, actually, that half of advisors today having implemented a CRP, a retirement proposition, as distinct from a CIP. That was only 17% at the beginning of last year at the time of the thematic review. It was 30% year end, 50 now, and 70 perhaps in 12 months' time. But you're also seeing the behaviours change. So something like 80% of advisors were using the same model portfolios for end clients in accumulation and decumulation at the beginning of that journey. That was, by the end of last year, that dropped to just under 2/3. So we're seeing how it's implemented change as well. And one thing I'd say from a Brooks Macdonald perspective is our takeaway from that thematic review was firstly fully supportive of the direction of travel, but we also give consideration to the risks associated with decumulation as distinct from accumulation. And that's a really important consideration for us, how we work with our advisors and clients, and ultimately how we put forward our best ideas to the market.
Yeah, and the product's a really important part of it, isn't it? Because that's there's the financial plan, which is the critical bit, but the investment solution needs to deliver on that plan so that the client has security and accumulation. They get the income they need, and they can pass on the wealth that they want to their children. And but that product question's really complicated because there aren't a huge number of products out there designed specifically for decumulation, but as we know, there's different risks in decumulation. And what we hear from advisors, they're really looking for flexibility because people spend, 25, 30 years in retirement, and their needs for income are going to change, and thinking about retirement as different life stages and having a long-term investment solution, but that offers the flexibility to allow the client to live the retirement that they'd like to and leave the legacy that they'd like to. It's incredibly complicated.
I think that's the thing, like post-pensions freedom, the choice, the optionality has increased, which I think is healthy, like healthy competition, healthy innovation. But at the same time, we are now matching that up against the complexity of retirement, not just necessarily in terms of the risks associated with decumulation, namely sequencing risk, longevity and inflation risk, and what I'm sure we'll touch on those, but also retirement behaviours are changing, phased retirement, part-time working, supplemental income. Our takeaway at Brooks is there's no one size fits all from here. Annuities are still perfectly relevant. In fact, we've seen a bounce, as we know, in the market in terms of their popularity, not to pre-pension freedoms level, but certainly relative to the last couple of years. At Brooks, our approach to this, we've been doing dedicated decumulation services since 2018, 2019. And we took it upon ourselves and said, well, listen to clients. How can we help them? We recognize that there are multiple price points, multiple demands and needs across the market. And we have centered and really focused in on helping individual client needs when it comes to addressing those decumulation specific risks, longevity, inflation, and sequencing risk. And the roadshows we've launched recently were specifically off the back of a trio of strategies along the same philosophy, which came about in the summer of this year, where we're genuinely interested in understanding advisors' views towards how their clients are different, what their needs are, and how we define success in the form here of having sufficient income over a sufficient period of time.
Yeah, it's incredibly complicated. And when I talk to advisors, they often say it's the thing that keeps them up at night is that fear that they will have advised their clients wrong. And so being able to rely on others in the market and partners is really, really important. And that question of risk, and when we keep mentioning this thing of risk, and I think it's a real bugbear for advisors because they rely heavily on the ATRQ, the Attitude to Risk Questionnaire, but they acknowledge that that's accumulation focused. It's really about the capital risk. It's not thinking about all those other risks that are so important in retirement: longevity, income, inflation risk, and there's so many other risks to take account of. And the approach most firms take is they combine that attitude to risk questionnaire, so the starting point, with cash flow modeling. And that leads to great conversations with clients, but getting consistency within firms can be difficult. Thinking about, you mentioned annuities, right? If we have that guaranteed underpin, can we up the risk for the portfolio? But the ATRQ score is typically mapped to the investment solution, and trying to manage that to have a suitable process that's repeatable, that you can justify in the long run, because you need to protect your business as well as an advice firm. It's incredibly complicated.
Absolutely. Let's talk about that. So if you look over the last 10, 20, 30 years, it wasn't uncommon to de-risk the portfolio in the latter stages of accumulation as we head into retirement, in part to reduce the volatility of the asset base, but also to align the interest rate risk with what was a journey into annuities there. But actually, coming back to that success measure for the end investor here, do I have enough money over enough time to do what I want to do? Okay, that requires investment risk as well. And actually, this comes on to how you define risk, and actually what I do think is different about the approach we take at Brooks here, which is to say, yes, absolutely, our retirement strategy solutions adhere to risk mappings per de facto, et cetera, dynamic planner. But more than that, they are designed specifically to cater for decumulation risks in the form of longevity, inflation, and sequencing risk. Now, what's interesting here is they almost at odds with each other to a degree. We have a two-pot approach to counter this. We have the first pot, which is your short-term pot, built of cash and fixed maturity investments that give you that alignment between your time frame and income needs in the short term. That accounts for sequencing risk. Sequencing risk being the risk that your pot draws down too early, too soon, you're not unable to fund a sustainable retirement in the medium to long term. But at the same time, we have a second pot, a growth pot, which is a risk asset portfolio designed to drive that further accumulation into the longer term as well. And the combination together, we feel, is a very powerful one to help advisors and their end clients in that secure retirement.
Great, and that's one of the most difficult things, is figuring out when to top up that lower risk pot, and that's what we hear from advisors. So working with partners is really important on that.
One of our creating these strategies, one of the key things is around flexibility, right? Circumstances change. Not only that, that flexibility, particularly within our so-called tailored and our bespoke models, which are the two where for clients with more nuanced cash flow needs, certainly for tailored, or more complex needs further with multiple tax wrappers at the bespoke end. The question really was, what risk can they tolerate? How can we incorporate that into the portfolio, but at the same time acknowledging that there is a cash flow need in the short term and that markets do move. And actually our 7-year bucket is different to most players on this basis, because that's the time we think is sufficient to mitigate the drawdown risk within the portfolios, that also allows that longer term pot to recover to drive further growth from there as well.
Great. Sounds like a lot of flexibility, which is back to the point about flexibility and decumulation is what advisors are looking for, to put those building blocks together, but also ask for help from others to be able to do that.
I think so. One of the better conversations, actually, coming back to the multiple investor needs comment, why we've designed this, there's no one size fits all, was that sitting down with an advisor and saying, let's help think about your clients and how either the modeled solution on platform for the more straightforward income needs versus tailored with greater nuance or even more bespoke, multiple tax wrappers, more complex investment needs. How might your clients fit into that bill? But across that span, the same philosophy of that two-prot approach. Sequencing risk is one area that keeps us awake at night. But also we think we've addressed the inflation and longevity risk through that growth portfolio as well. So these solutions, they've been designed in that hybrid capacity to deal with the balance of complexity, the balance of the need for cash in the short term, the balance for need for growth, and also the fact that circumstances change. And this is really where the integrated nature of wealth management comes into play. The wealth manager plus the investment manager where appropriate, the advisor and the client, as long as that communication stays open, I think we're in a good position to help people as they move further into that retirement journey. It is a journey, not a destination. I think we need to reflect that in the product suite we offer. Absolutely.
It's such a shift, isn't it, from that cliff edge retirement to that journey through retirement, as I mentioned, 25, 30 years into accumulation. And I think that challenge of being able to deliver that flexibility through those different phases is so important, and but also thinking about the needs for different clients. And I think the segmentation, you mentioned client segmentation, there's been great solutions for ultra high net worth clients, but thinking about the wider set of clients that advisors are supporting, but also the wider market out there, just finding those different solutions for different segments of the market is so important.
Yeah, and what a great time to have this conversation today. I mean, look at geopolitical risk, look at the relatively healthy valuation of many markets out there, not least the US exceptionalism. You think an advisor at the moment is saying, I'm taking substantial assets from someone who's built them over many, many decades. How do we make sure that we do the best job as possible? And I think that really was the genesis of the retirement strategies approach that we put together at Brooks, to think, well, we want to do both. We want to make sure that entering that retirement phase, we're firstly recognizing that decumulation is a different journey to accumulation in terms of the risk you face and also the risk tolerance you have. But also that, yes, though that short-term pot of cash flow assurance, that's important, but actually that 7-year period is just the start. How do we continue from there, hence the second growth pot as well. So just to reiterate on that point, that sequencing risk in accumulation of volatility is your friend. That helps you grow wealth over time. It risks being a foe into accumulation, certainly at the shorter end of the journey, where a drawdown in the early years can materially, detrimentally impact the amount of money you have and the income you have. Sequencing risk is a direct function of the income levels you have. So that tailored need to understand, what does the client need? How can the advisor help them implement that? We very much hope that at Brooks we have a solution across that spectrum to help clients secure a fulfilling retirement in line with their needs.
Great. But really fascinating having this conversation.
Well, hopefully we can touch base again in 6-12 months and see how the journey goes. You mentioned we've gone from 17% of advisors having a CRP January last year when the thematic review came out. That was 29% end of last year. It's 52% now, another 20 in the works. We welcome these conversations, and as you say, CRP is the framework. There's no one product that will suit all of those, but we would like to play our part in that. Anything from annuities up to the bespoke and custom end of decumulation services. It's a great time to be having these conversations, and we look forward to continuing that with you and our clients.
Great, thank you.
Thank you.